So there's a lot happening in the property market right now, and I just really want to have a conversation about it. This isn't political spin or whether I think it's right or wrong to change the budget and update tax reforms. And I don't want this to be about the politics. I just want to have a conversation about it. And I don't think this should be purely viewed as a tax conversation. It should be more about behaviors and what the likely impact of those behaviors are. Because at the end of the day, when tax rules change, the incentives change, and as a result, people shift their focus. And then these behavior changes, they may shift the supply and demand of property in given areas and even the economy as well. So look, be that as it may, this conversation is really only going to be general in nature. I'm going to try and remain as factual as possible, and anything that I say is only purely general in nature. It's not financial advice or personal advice. And I strongly encourage you to go see a financial services professional if you're curious around how these proposed budget changes and tax reform affect your financial situation. And again, this is really just general commentary. So in this video, I'm going to go through a few points. I'm going to talk a little bit about the decline that we're seeing in Sydney and Melbourne at the moment. I'm going to talk a little bit about the capital gains tax changes and the choices that investors may face before and after the proposed 1 July due date deadline for the 50% CGT capital gains discount. We'll talk about how I feel that negative gearing could potentially create a two-speed economy for grandfathered investors and future investors or future homeowners. And then we'll talk about why rents are rising currently, or why I feel rents are rising currently, and why I feel that rents will rise in the future after the 1 July 2027 negative gearing deadline. We'll also talk about the 5% deposit scheme and how I feel that it's impacting a large number of people that may have purchased property at inflated prices, and even more so how they may now be in negative equity as a result of softness in certain markets and decline that we're seeing in price growth. And then just some of the impacts associated with that negative equity. We'll also talk about the incentives towards new builds and why I'm fairly against house and land packages and off-the-plan apartments, but even more so with investors being incentivized to purchase those house and land packages and off-the-plan apartments. We'll also talk about CGT changes outside property, potentially hurting those young people that are trying to build a deposit outside of the property environment. And then the behavior around some investors who have those grandfathered properties remaining with them and them being more tightly held rather than letting go of them after a certain point. We'll talk a little bit about the focus of investors or the potential focus of investors going forward in the property market. And just a reminder that this is more of a behavioral perspective. I really don't want this to be about political right and wrong in terms of the budget. I really just want to have some general dialogue and commentary around investment and the property market. So that being said, I didn't want to make this scripted. I really just wanted it to be off the cuff and honest. So let me know what you think of this format. So firstly, we're seeing declines in predominantly Sydney and Melbourne at the moment, and this has been coming on for a couple of months. Often we see price growth and we're seeing the property market is going down, but it's a lagging metric because we really only see property prices as has happened after the fact. And this is often representative of a metric called the home value index. And then in the news, they'll often report either the median price point is down or the home value index is down. And this is because of sales that occurred over the previous months. In Sydney and Melbourne, over the last couple of months now, we've seen successive month-on-month decline in property prices. And even over the last rolling quarter in Melbourne and potentially Sydney, we've seen declines in property prices. And a lot of people are saying the budget is to blame for this, but I don't think that is the case because it often takes a couple of months to feel the full force of an interest rate rise. So we're yet to see the impacts of those interest rate rises, number one. Number two, inflation has crept its head up again, and as a result, that has impacts on the underlying expenses associated with property. So that being said, the holding costs in general associated with holding property in Sydney and Melbourne are more expensive, especially because they're at a premium price point. And generally, the rental yields in Sydney and Melbourne aren't as high as we see in some regional areas. So those investors that are holding onto properties are really starting to feel the pinch. So for me, where we start to hear around reports of rents rising, I don't feel it's because of the budget, because in all seriousness and in reality, we're not seeing financial impacts as a result of tax reforms and the proposed budget changes. And we won't see these impacts until existing investors purchase property and the negative gearing changes are removed from 1 July 2027. And this goes for all purchases after the budget date, which was 12 May. Now, those existing property owners will have a choice in the coming months. And the choice will be whether they effectively sell their property now or hold on to it. And the reason why I say this is because of the changes to capital gains tax. So part of the budget tax reforms was to change capital gains tax from the 50% discount to the indexation method. So existing investors that have investment property essentially have a decision between now and when the indexation rate will take effect on 1 July 2027. Either they sell now and take advantage of the 50% capital gains tax discount, or hold on to their property and eventually sell their property using the indexation method. And effectively, as an investor, they'll want to do what's best for them, whether they receive more after the 50% discount or whether they're likely to hold on to it and potentially get some more exposure to capital growth and sell it eventually after holding on to it for a little bit longer. So again, this applies to existing investors who hold property or any investment really, and they sell that after 1 July 2027. So there's a little bit of time still to make that decision. But we may potentially see people look to list over the next 12 months and a little bit more supply come into the market because of that decision. That remains to be seen yet. Let's move on to the third point. So effectively, existing property owners will be able to negative gear beyond the 1 July 2027 cutoff date. And what I fear is that this may create a bit of a two-speed economy, because as an investor, if I have a grandfathered property, then essentially what I'm likely to do is keep the debt high and recycle those funds into other investments that are either cash flow neutral or cash flow positive. So I worry a little bit about this creating a two-speed economy between the grandfathered property owners and the new property owners that purchase property after 12 May 2026. The likely behavior will be that existing investors will hold on to those grandfathered assets because they are in diminishing supply, and they'll simply maintain higher debt levels. So again, they'll look to recycle those funds into other investments. And moving on to point 4. So part of point 4 was discussing around why rents are rising. So look, we did discuss this a little bit already, but I really feel that it's not because of the tax reforms. Investors at the end of the day, they have to justify why they're raising rents. And normally to do that, it's the property manager will prompt them to do a rent review towards the end of a lease agreement or a lease term, and they'll provide them with a comparable market appraisal based on what is renting or what is for rent out in the market. So there really needs to be justification. Otherwise, normally what will happen is, depending on state by state processes, is the renter will go to tribunal and they'll challenge that market rent. So in a lot of states, you need to justify why you're raising it to that rate. You can't just raise rents. And I feel that currently that is the case because of the underlying pressure on home ownership. We're seeing a diminishing supply in a lot of areas for rental properties specifically. Vacancy rates are well below 2%, and in some cases they're lower than the Australian average of 1.5%. So there is further fuel to push rent prices up, and we're seeing more fuel because of those expenses come up for the underlying costs associated with purchasing property, like council rates, strata, water, insurance premiums. They have all gone up over the last few years. And then we're also seeing interest rates come back up again. We've had 3 successive interest rate rises as a result. So the underlying costs associated with holding property is more expensive. And therefore landlords are in some cases asking for a rent rise, but also property managers are prompting a rent rise at the end of a lease term and doing that comparable market analysis and appraising the rent at a higher rate. If tax reforms do add pressure to that, it's because we see new investors enter the market and they buy property that doesn't have the negative gearing incentive associated with it. And that could potentially cause rents to rise, but only from the 1 July 2027 cutoff date for new investors. All the other grandfathered investors will still be able to negative gear. And that brings us to point 5 around the 5% low deposit scheme. In some cases, that's 2% deposit for single parents. Now, I'm somewhat cautious to talk about this. There's been a number of first-time buyers that have gone out and purchased property using the 5% low deposit scheme, or some single parents that have purchased under the 2% low deposit scheme, and they are either in now or they could potentially be in a position of negative equity where effectively the loan is higher than the value of the home. And a lot of the commentary around this is, so what? They just won't sell. But there could be instances where they're actually forced to sell in an economic downturn, when people start losing their jobs, when repayments move beyond what they're financially able to pay, where there's a relationship breakdown, where there's a death or divorce in the family. There's a number of instances where you actually need to pay back the funds, or you can no longer hold on to the property and you're forced to sell the property as a result. And this means that effectively the government guarantees the remaining 15, 18%, whatever it is. And essentially the first home buyer only is liable for the 80%. So be that as it may be in quite a predicament when those events start to happen and those first home buyers that purchase under the low deposit scheme are forced to sell as a result of those scenarios. And I'm somewhat cautious of that fact as well. I'm not yet fully across what the economic impacts could be, but I'm just very cautious about it. Now, moving on to point 6 was around negative gearing and capital gains tax incentives are being applied to off-the-plan apartments and house and land packages, essentially brand new properties. So long story short is negative gearing and the 50% CGT discount will apply to house and land packages, off-the-plan apartments, turnkey developer stock, new build estates, and the like. I'll let you look it up as to what exactly it pertains to. What I feel and fear will occur is that there's going to be a massive oversupply of new builds. And this will actually put downward pressure on that new stock because they lack scarcity essentially, and there's an oversupply. In addition, I worry that these properties will come at a premium because they have inbuilt costs like marketing and sales commissions associated with them. And effectively, they are likely to have weaker resale demand because the subsequent owners will no longer have those same benefits applied to them, like negative gearing and the 50% CGT discount. Furthermore, we're seeing more and more builders go essentially bust as a result of the rising construction costs associated with new builds. And we're seeing more and more instances of construction defects, especially with off-the-plan apartments. So as a result, we're seeing lower quality finishes and higher construction costs as a result. Furthermore, typically these properties are either in high density locations, especially the off-the-plan apartments, they're in high density locations where there's a ton of oversupply, or they're in new developer estates where there's a ton of cookie cutter house and land packages out there, and they're typically on the fringes of capital cities and they have no real infrastructure to support those estates, and you often have to travel. So there will be somewhat reluctance associated with purchasing those properties because there's a lack of infrastructure. I say all the time, a tax benefit on a poor investment is still a poor investment. So look, at the end of the day, I'm very cautious around just purchasing property because there are tax incentives associated with it for those reasons. Moving on to point 7 around capital gains tax changes, potentially hurting those that are looking to build a deposit to purchase a home. Now, this is a broader economic point and it's very controversial as well. Essentially, the 50% capital gains tax discount has been removed from all investment, from all assets, and from 1 July 2027, it'll move to the indexation inflation method. And there's been a lot of talk around how this will actually make it harder for people to build a deposit outside your typical savings accounts, where especially young people will invest in ETFs and shares and managed funds, and especially those assets that effectively need to grow not only beyond inflation, but beyond the rate at which property grows. They are likely to be hampered as a result of no longer being entitled to that 50% capital gains tax discount. In addition, there's been massive uproar around the business community as well, effectively saying that they're giving 47% of their business away to the government. So this has been a highly debated topic. There are some concessions as well that may still apply for businesses that are looking to sell their property, and it's important to understand those nuances as well. I really want to urge caution and get people to understand with a discussion with their accountant around what the potential impacts there are to building assets in anticipation to put a deposit down or selling their business, and what some of the concessions are associated with that as well. Overall, I feel that established property are going to be more tightly held because typically these are in more desirable locations where there's existing infrastructure in place, quality standards have stood the test of time, and they're closer to amenities. They're just overall in a higher, more desirable place to live. And the behavior I feel is that there's going to be fewer sales. Essentially, only owner-occupiers are going to be selling their property should they want to upgrade or downgrade, whichever. And that's because capital gains tax doesn't apply to owner-occupied property in most cases. So there's going to be less established stock lying around because those grandfathered investors are less likely to sell. There's going to be a higher value placed on those properties that are purchased pre-budget, and more likely, again, to refinance and reinvest those funds that were released via equity unlock into other assets. I really feel that investors are only likely to sell if they really need it or they're forced. Going forward, ultimately, I feel that we're going to move from an environment of capital growth to cash flow. And that brings me to point 9, being investors becoming more cash flow focused, because the gloss is being taken off, or the desire to overly achieve more capital growth than cash flow is being taken away through the removal of the negative gearing discount in some cases where you have grandfathered property. And so going forward, and I feel that investors entering the market will place favour on higher yielding regional markets. They could potentially look to knock down and build duplexes or triplexes, or develop, potentially look at putting granny flats in place as part of a higher yield play, purchasing houses at a lower price point so they can put down a bigger deposit and reduce their lending requirements, moving towards positively geared assets in general, purchasing commercial property where negative gearing benefits still apply, buying inside the SMSF where there's certain tax concessions associated with superannuation in general, and then in some cases purchase new builds, even though I'm not a big fan. So look, at the end of the day, political allegiance aside, this is simply just the impacts that I feel will happen to the property market, and it's just a general discussion. At the end of the day, it still remains to be seen what is going to be legislated. It's still not legislated. It's only a proposed budget changes. So look, I'm curious to hear what you think will happen to the Australian property market. Leave your thoughts in the comments below. I'd love to hear them. Thanks again for watching, and I'll catch you in the next video.